gold has glittered really. Is it a bubble or is there more? Naresh Kataria comes in with his thoughts. He's a private investor. Naresh, great having you, as always. Thank you so much for taking the time out. But you are spot on, Naresh. While a lot of naysayers and doubters existed about the extent of the rally, you were all in, and I'm happy for you. Can't say I'm as happy for myself. But I would love to know if investors should stay bullish, and if you are bullish right now, Naresh, on gold here on.
Good morning, Neeraj. Good morning, Alex. Happy to be on show again. So, post our conversation in March, it was exactly 6 months back, and you were one of the earliest leading channels to really start covering gold. Something very important is been happening. So, for the previous bull market is what we have seen, the 2000s bull market, gold was led by retail. If you track the ETF flows across all ETFs globally, they used to go up as gold went up. It means retail was piling on. But this time, I think it's quite different. I'm actually a little perplexed who's driving this bull market, because the total tonnage across all ETFs, across gold, all gold ETFs globally, is under 4,000 tons today. It was 4,000 tons in 2020, and gold is up 85% from then. So retail is frankly missing at the party. That's a key point I want to make. Retail is just warming up. Of course, gold ETF inflows have started going up. And the biggest buyer, which is India, even that's not been really playing a very big role. Indian gold imports, because we hardly manufacture anything. Indian gold imports for this fiscal till date is flat YOI. So it's a very, I would say, perplexing setup to me. And hence, I think there are some very large hands who are behind this gold bull market.
And so therefore, would you call it though? Would you be cautious at this point, Naresh? In the past, you've been bullish. Would you say it's time to perhaps, if you managed to get in earlier, maybe a year back, and nobody says you buy and sell gold like you would trade equities, but then at some point you have to rebalance if there has been a dramatic shift in your allocation. And let's also talk about silver in that context, because it's played catch up with gold over the last 2.5 months, and that gold-silver ratio is much more palatable right now. So talk about both of those.
So Alex, I would have normally been slightly cautious in a normal bull market, like I played the 2000s bull market. What's happened, a very important development 2 weeks back, is a top wealth manager across the globe, Morgan Stanley, has recommended a gold allocation to its wealth clients. And that was 20% allocation. I mean, I'm actually amazed there is hardly any discussion on that topic, because that wealth outfit advises trillions of dollars, and leave 20, even a 2% gold allocation, there will not be enough gold around at current prices. So I think there's a new leg which has come up to the gold bull market. And as I said, that if it was a normal bull market, then the flows should explain. The flows by declared central bank buying, or by Indian jewelry buyers, or by ETF investing public flows, are not adding up to the strength in gold. And hence, and plus this new institutional leg up. So I would stay put. I think the gold bull market has many more legs. Of course, it's run up, it's stretched, it is up 45% roughly in the last 1 year in dollar terms. So I would be a little, I would say, not as bullish as I was, but to me, it looks very, very interestingly poised. And Alex, coming to silver, I've been frankly a little late to the silver party, because I thought it's only central banks who are only buying gold and not silver, but a couple of central banks have started buying silver. And silver is also an industrial metal. It's found a big use in solar these days, but although there are efficiency gains coming in. So yeah, I think it's gold's poor cousin. It's a much smaller market. Gold is a $25 trillion asset. Silver is not even probably 5% of that. So I would have a larger allocation to gold and a much smaller one to silver.
Okay, now viewers, just one point. I just want to show this chart that Naresh Kataria has given us, and in some sense, Naresh, please enlighten us as well, but in some sense, it shows that the buying of gold, which is this dollar price in the yellow chart or the yellow line, has been accompanied by actual accumulation of gold. And what Naresh Kataria just mentioned, that if Morgan Stanley and other institutions are allocating more gold into their portfolios and recommending 20% allocation, imagine the extent of buying that comes in. And imagine what happens to that blue line out there. Now, Naresh, my question therefore is this, that is it possible that what is happening right now, and people equate conflicts to gold price rise. This may not be necessarily conflict. This may be hedging by countries, by institutions against currency debasement. And therefore, what you said, that this rally has more legs to go. Yes, it might have more legs to go over the number of years, but it also might have serious outperformance than the 12-13% that we've been used to every year for the last few years.
Yes, Neeraj. So that's a very interesting chart you pointed out to. And as I mentioned in my talk a little earlier, retail has been really missing. So the total ETF tonnage across all gold ETFs combined, including India, US, Europe, Australia, is today under 4,000 tons, and it was 4,000 tons in 2020 already. And normally, as we've seen in the previous bull market, ETF tonnages increase as gold price goes up because that's how investors are. They chase performance. And now, of course, they have turned, but 22, 23, gold price went up, but the tonnage was dropping. So, and obviously it was central bank buying, which was taking it up. Retail is just joined. And yeah, I think that's my actually a little bit more of a positive tilt to gold, that retail is just joining the party. And in fact, you'd be amazed, Neeraj, that see the disbelief in gold that we spoke about it last time. Jewelers, for example, who sell gold, they are usually short gold. They hedge their gold. They short on MCX. They somehow don't want the gold upside. Imagine you are a real estate developer selling apartments and you short your land because you say, no, I don't want the upside from land. So I think it's a very interesting setup, very interesting mindset from investors. And it all, I think, should play out as the gold price rises.
Absolutely, and anybody's guess as to where that will be. We're already at all-time highs. Naresh, as always, thanks so much for taking the time. Pleasure speaking with you.